One California region quietly crossed a line few people expected. More homes entered foreclosure than new households were formed. Not in Los Angeles, not in San Francisco, but in cities people once trusted safer, more affordable alternatives. That's where the real shift is happening. Because this isn't just another housing slowdown, it's a structural imbalance forming beneath the surface. On paper, California still looks strong. Prices remain elevated. Inventory is tight. Demand hasn't disappeared. But underneath, the signals are changing. Mortgage delinquencies are rising in specific regions. Vacancy rates are increasing. Entire neighborhoods are beginning to lose consistency, not all at once, but gradually. The issue is no longer just affordability, it's sustainability. California has always struggled with housing supply, but now the pressure is shifting geographically. Coastal cities, supported by higher incomes and stronger job markets, remain relatively stable. But inland and secondary cities, the places that absorbed migration during the pandemic, are now carrying the strain. Prices in these areas surged between 2020 and 2022. Incomes did not keep up. Then interest rates rose, and the balance broke. Now the same locations that once offered relief are showing early signs of stress. Number 10, Stockton. Stockton has been here before. After the 2008 financial crisis, it became one of the most visible examples of collapse. It rebuilt slowly, regained confidence, and saw prices rise again. But in 2026, familiar patterns are returning. Mortgage delinquencies are increasing. Foreclosure filings are trending upward. And while home values remain above $450,000, local incomes are still under $70,000. That gap matters. Because once it widens too far, defaults follow. Entire neighborhoods are showing subtle signs of instability. Not dramatic abandonment, but quiet shifts. A house with no lights at night, a yard no longer maintained, a listing that sits for months without interest. This isn't a crash yet, but it is a warning. Number 9, Victorville. Victorville was marketed as an escape. Lower costs, more space, a fresh start away from coastal pressure. During the pandemic, it worked. Remote work made distance irrelevant. But by 2026, that advantage has weakened. Mortgage default rates have increased. Demand has slowed. And the local economy, limited in diversification, is struggling to support long-term growth. Home values have stopped rising, but debt remains fixed. That creates pressure. Homes are staying on the market longer. Vacancies are becoming more visible. And without strong economic expansion, recovery becomes uncertain. Number 8, Antioch. Antioch became an overflow zone for the Bay Area. When prices surged in San Francisco and Oakland, buyers moved outward. Antioch benefited from that movement, but the stability didn't last. Ownership turnover has increased significantly. A growing number of buyers leave within 2 years, not because they upgraded, because they couldn't sustain it. Long commutes, rising costs, and limited infrastructure have weakened the value proposition. The result is a market without continuity, and when continuity breaks, confidence follows. Number 7, Riverside. Riverside looks stable on the surface. Suburban growth, expanding communities, continued development, but the numbers tell a different story. Median home prices are approaching $650,000, while median incomes remain just above $60,000. That imbalance is significant. Households are stretching financially to maintain ownership, debt-to-income ratios are rising, and early signs of stress are beginning to appear in delinquency data. This is how risk builds, not suddenly, but gradually. Number 6, Modesto. Modesto is experiencing one of the fastest increases in eviction activity in the state, not because demand disappeared, but because affordability did. Rents have risen sharply, while incomes have remained relatively flat. Landlords are adjusting quickly. Investors are rotating properties, and long-term residents are being displaced. This creates instability at the community level. Housing exists, but it is no longer accessible to the people who depend on it. Number 5, Oxnard. Oxnard presents a different type of imbalance. It is a coastal city, desirable and visually strong, but beneath that appeal is a widening economic divide. Home prices exceed $700,000, yet a significant portion of residents remain under financial strain. Investors entered aggressively during the last cycle. Now some are pulling back. Vacancies are rising in certain segments, particularly in investor-heavy areas. The market is becoming uneven. Number 4, San Bernardino. San Bernardino continues to lead in foreclosure activity. This is not a new pattern, but it is persistent. Income levels remain lower, employment stability is inconsistent, and as a result, housing stress appears more frequently. Entire neighborhoods show signs of financial fatigue, multiple homes in distress, reduced buyer activity, and slower recovery cycles. This is not a sudden collapse. It is a prolonged erosion. Number 3. Bakersfield. Bakersfield was once seen as a stable working-class housing market, affordable, accessible, predictable. But conditions have changed. Vacancy rates are rising, foreclosure filings have increased, and home prices have started to soften. Even small declines create pressure for buyers who entered at peak levels, because their financial margin was already thin. Number 2. Fresno. Fresno has experienced rapid price growth over the past decade, but income growth has not matched that pace. Now the imbalance is becoming visible. Defaults are increasing, investor activity is slowing, and the market is beginning to adjust, not sharply, but clearly. Momentum has shifted. Number 1. El Centro. El Centro represents a different kind of risk. Not overheating, but underparticipation. Home prices are relatively low compared to other California cities, but demand is limited, unemployment remains high, economic opportunities are fewer, and population growth is minimal. Vacancies are increasing not because people are leaving quickly, but because fewer people are arriving. That distinction matters, because it signals a deeper structural issue. Looking ahead, several factors will shape what happens next. Interest rates remain elevated, limiting affordability. Migration into secondary markets has slowed, and investor activity is becoming more selective. If these trends continue, pressure on these cities may increase, not suddenly, but steadily. This is not a uniform collapse across California. It is a redistribution of risk, from major urban centers to the places that once absorbed the overflow, and that makes it harder to detect, because the overall market still appears stable. But stability at the top can coexist with weakness underneath. The question is no longer whether California housing is expensive. That has already been established. The real question is where the imbalance becomes unsustainable first, and more importantly, who remains exposed when it does. Because in markets like these, the shift doesn't happen all at once. It happens gradually, until suddenly it's already too late.